I'm going to say something right now that is going to contradict almost everything you've been told about silver, not by conspiracy theorists, not by internet speculators, but by the mainstream financial system, the banks, the advisors, the analysts who have spent the last decade telling you silver is a fringe asset, a relic, a volatile commodity for gold bugs and doomsday preppers. Here's what they didn't tell you. Silver is sitting on the edge of the most significant repricing event in modern financial history. And the surprise, the one coming for both the people who ignored silver and the people who are already in it, is going to be unlike anything this market has produced in 40 years. The question is whether you're going to be ready for it. Before we continue, and what I'm about to show you in this video is genuinely something I believe every serious investor needs to understand. I want to mention something important. If you're serious about understanding the financial system before the crowd does, consider joining our channel memberships. We have 5 tiers designed for exactly where you are in your financial journey. Wealth Apprentice, Palling, Financial Titan, Banking Insider, Capital Master. Chairman Circle members get exclusive financial insights, behind-the-scenes analysis, early access to select content, and special members-only updates designed to help you stay ahead of the economic shifts most people never see coming. Click the join button below and become part of the inner circle. Now let's get into what I came here to tell you. Let me give you the landscape first, because context is everything. We are sitting inside the longest period of monetary distortion in modern history. Central banks around the world have for over a decade held interest rates near zero, printed money at a pace that has no historical precedent, and in doing so created an environment where almost every traditional asset, stocks, bonds, real estate, has been inflated to valuations that only make sense in a world of infinite cheap money. That world is ending not gradually, not politely, but with a kind of violent recalibration that always follows extreme distortion. And inside that recalibration, inside the shift from an era of cheap money and paper promises to an era where tangible, finite, real assets reassert their value, silver occupies a position that is genuinely extraordinary. But here's where I need you to pay close attention, because the surprise I mentioned at the start, the one coming for silver investors, is not simply that the price goes up, it's how it goes up. How fast it goes up, and why most people, including many current silver investors, are going to be caught completely unprepared for the mechanics of it. Let me explain what I mean by that. Most people who think about silver think about it as a slow, grinding asset, something that moves with gold, something that takes years to develop. They think of it the way you think of a reliable but unremarkable investment, steady, dependable, boring, and for long stretches of time, that perception is accurate until it isn't. Silver has a documented history of doing something that almost no other asset class does. It moves sideways, it consolidates, it frustrates, it tests the patience of everyone holding it, and then without significant warning, without a clear trigger that the mainstream media identifies in advance, it moves not 10%. In 1979 to 1980, silver moved from under $6 to nearly $50. That is an 800% move in approximately 14 months. In 2010 to 2011, silver moved from under 20 to 49. I need you to hold in your mind, both of those moves happened in environments that were less extreme than the one we are currently navigating. The debt levels were lower. The monetary distortion was smaller. Industrial demand for silver was a fraction of what it is today. The geopolitical fragmentation of the global financial order had not yet begun. We have all of those factors simultaneously right now, and no one is talking about what that combination actually means for the timeline of the move that's coming. I want you to think about a man named Robert who's 54 years old. He's been a careful investor his whole life. Diversified portfolio, some stocks, some bonds, a little real estate. He reads the financial news every morning. He has a financial advisor he trusts. In 2010, a colleague told Robert to look at silver, gave him the thesis, the monetary argument, the supply dynamics. Robert listened, nodded, and said he'd think about it. He never bought it. He watched silver go from $18 to $49 in 8 months, a move that would have turned a $50,000 position into over $135,000, and he missed it entirely. Not because he didn't know, not because he didn't have the resources, but because the mainstream financial system he trusted told him it was speculative, it was volatile, it wasn't appropriate for serious investors. Robert is not a cautionary tale about being wrong. He is a cautionary tale about being right and not acting. And today, Robert is 54 years old, watching the same signals appear again in a macro environment that is dramatically more extreme than 2000. And the question he has to answer, the question you have to answer, is whether this time is going to be different. Not whether silver will move, but whether you will be positioned when it does. Let me be blunt. The financial advice industry is structurally incapable of telling you to buy silver in a meaningful way. not because the people in it are dishonest. Many of them are brilliant, decent professionals, but because the incentive structure of that industry rewards what is conventional, what is defensible, what is consensus. Silver is not consensus, and that is precisely why the opportunity exists. Every truly significant financial opportunity, history, every moment where fortunes were made by ordinary people, not just institutions, happened in the gap between what the consensus believed and what the evidence actually showed. We are in that gap right now, but here's what I haven't told you yet. The surprise I mentioned, the one that's coming for silver investors, is not just about price. There's a structural development happening inside the silver market right now that the vast majority of investors, including experienced ones, do not understand. It involves the relationship between paper and physical silver. It involves what happens when those two things, which have been artificially linked for decades, begin to diverge. And what happens when they diverge is not gradual, it is sudden, it is disorderly. And the last time it happened partially, incompletely, not even to its full conclusion, silver nearly hit $50 an ounce. We are closer to a complete divergence today than at any point in the last 40 years. I'll show you exactly what that means in part 2. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on, subscribe to the Diamond Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. Stay with me because in part 2, I'm going to show you the paper silver time bomb, what it is, how it was built, and why when it finally detonates, the investors holding physical silver are going to experience something the paper traders never anticipated. The surprise is coming. The only question is which side of it you're on. The paper time bomb underneath silver. There are two silver markets. Most people know about one of them. Almost nobody truly understands the other. And the relationship between those two markets, between paper and physical silver, is the most important thing happening in the precious metals world right now. More important than the price, more important than the chart, more important than any analyst target. Because when that relationship breaks, and I am telling you with the confidence of someone who has spent 40 years watching financial structures crack, when it breaks, the result will not be orderly. And the people who only understand the paper market are going to be blindsided. Let me explain what I mean by two markets. The paper-silver market is the COMEX, the exchange where silver futures are traded. On any given day, the amount of silver changing hands on that exchange in the form of contracts, futures, options is staggering. We're talking about hundreds of millions of ounces worth of transactions. The physical silver market is the actual metal, the bars, the coins, the industrial inventory, the real finite minimal supply that comes out of the ground. Here is the critical fact. The paper silver market trades a volume of silver that is approximately 250 to 300 times the amount of physical silver that is actually available for delivery. Let me say that again. For every ounce of real physical silver that could actually be handed to someone if they demanded it, there are 250 to 300 ounces of paper claims on that silver. This is not a secret. It is documented. It is legal. It is in the language of the financial system, normal market functioning. But here's the truth nobody wants to hear. It is only normal market functioning as long as nobody asks for delivery. And for most of the last 4 decades, nobody did ask for delivery, not in significant numbers. The system worked because the participants, the banks, the funds, the institutions were playing a paper game. They didn't want silver, they wanted exposure to silver prices. The actual metal was beside the point. But something changed. And what happened next was worse for the paper system than anyone in the mainstream financial establishment wants to acknowledge. In 2020 and early 2021, retail investors, ordinary people, not hedge funds, not institutions, began buying physical silver at a rate that had never been seen before. The Royal Canadian Mint reported backlogs of months. The U.S. Mint suspended sales of silver eagles. Dealers ran out of inventory. Premiums, the amount above spot price you pay for physical metal, exploded from 35% in a matter of weeks. The paper price barely moved. Think about what that means. The physical silver market, the real market, the one involving actual metal, was signaling a supply crisis. Premiums were screaming that there wasn't enough silver to meet demand. Meanwhile, the COMEX paper price controlled by the 250 to 1 leverage structure I described barely blinked. Two markets, one physical reality, one paper construct. They diverged temporarily. Now imagine what happens when that divergence is permanent. Here's the truth nobody wants to hear. The COMEX paper silver price is not a reflection of silver's true value. It is a reflection of the supply and demand dynamics of paper contracts. It is a managed number, not managed in a conspiratorial backroom sense, but managed by the simple mathematical reality that when you can create 250 paper ounces for every physical ounce, you have enormous influence over the price discovery mechanism. This is precisely how a commodity with genuine supply deficits, silver has had a physical supply deficit for multiple consecutive years, can still trade at prices that don't reflect that scarcity. Paper supply is nearly infinite. The physical supply is not. And the moment a critical mass of participants moves from wanting paper exposure to demanding physical delivery, the moment the floor falls out from under that 250-to-1 ratio, what happens to the price is not a gradual adjustment. It is a revaluation, sudden, dramatic, unlike anything the modern silver market has experienced. There is a historical precedent for exactly this kind of structural break. In 1979 and 1980, the Hunt brothers, two Texas oil billionaires, began accumulating physical silver, not paper, physical. They started buying contracts and demanding delivery instead of rolling them over the way every other participant did. As their physical holdings grew and as other investors began to follow, something extraordinary happened. The paper price began to detach from its normal suppressed range. Silver went from $6 to $445 in roughly 14 months. Now here's what most people don't know about that story. The Hunt brothers never controlled the majority of the silver market. Their holdings were significant but not dominant. What they did was demonstrate to a market built on the assumption that nobody would ever demand physical delivery at scale, that the paper to physical ratio was a fiction that could be challenged and the market were priced accordingly. The full repricing was stopped forcibly. Rule changes were made. The system protected itself, but the signal was unmistakable. The paper price of silver is a ceiling built on the assumption that most holders never ask for the real thing. Roam that assumption and the ceiling disappears. I need you to understand what this means for your position. If you hold silver in an ETF, a paper instrument that tracks the silver price, you are exposed to the paper market. You benefit from price movements. Yes, but in a scenario where the paper and physical markets diverge significantly, there's a meaningful question about whether your paper claim can be redeemed at the real physical price. If you hold physical silver, actual bars or coins in your possession, or in allocated audited storage, you hold something that no bank can create 250 copies of. You hold the real thing. And in a market where the real thing becomes scarce, genuinely, visibly, undeniably scarce, the real thing commands the real price, not the paper price, the real price. But there's something I haven't addressed yet, something that makes this moment, this specific window we're in right now, different from every previous silver cycle. It's not just the monetary pressure. It's not just the paper to physical ratio. It's something happening in the industrial world that is going to consume silver at a rate that the mining industry cannot possibly match, and most people, including most silver investors, have not fully processed what this means for availability of physical metal in the coming years. The number I'm going to show you in part 3 should stop you cold if you want to stay ahead of the financial system. Understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on. Subscribe to the Dimon Standard. Here we uncover the hidden truths about silver economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. The industrial demand story is the one that changes everything, because monetary demand for silver, the investment thesis, the inflation hedge, the dollar alternative that comes and goes with cycles, it's powerful, but it's cyclical. Industrial demand is permanent. And what the green energy transition, the AI hardware revolution, and the defense sector are about to do to silver consumption permanently, structurally, irreversibly, is a story that makes everything I've told you in the last 2 parts look like the setup. Part 3 is an up punchline. Don't go anywhere. The industrial shock that changes everything. Every solar panel manufactured today contains silver, not as a minor component, as an essential one. Silver is the most electrically conductive metal on Earth. It cannot be replaced in photovoltaic cells without significant efficiency loss, and the world is building solar capacity at a rate that is, by any historical measure, staggering. In 2023 alone, global solar installations consumed approximately 200 million ounces of silver. Total global silver mining production in that same year was approximately 820 million ounces. That means solar panels alone consumed roughly 25% of everything the world mines. Now here is the number that should stop you cold. Solar installation targets for 2030 require silver consumption that by some estimates will exceed total current global mine production by itself. Before we add electronics, before we add electric vehicles, before we add medical devices, military applications, semiconductor manufacturing, and the exploding demand from AI data center infrastructure, the math does not work. And when the math doesn't work in a commodity market, when demand structurally outpaces supply with no clear resolution in sight, the market finds its own solution. It's called a price increase, a significant one. This changes everything, not because silver hasn't had investment cycles before, not because the monetary argument is new, but because this is the first time in the history of the silver market that monetary demand and irreplaceable industrial demand are colliding simultaneously. In 1980, the silver spike was purely monetary and speculative. Solar panels were a novelty. Electric vehicles didn't exist. The AI revolution was a science fiction concept. Today, the industrial consumption floor for silver is enormous and growing. Even if you removed every monetary investor from the equation tomorrow, every person buying silver coins, every ETF, every futures trader, the industrial demand alone would be sufficient to create a supply problem. Add the monetary layer back in the inflation fear, the dollar debasement, the flight from paper assets, and you have a demand structure unlike anything this market has ever faced. I want you to imagine two conversations happening simultaneously right now. The first conversation is in a boardroom in Tokyo. A solar panel manufacturer, their procurement team is on the phone with their silver supplier trying to lock in contracts for the next 18 months. The supplier is telling them that availability at current prices is not guaranteed, that the market is tightening, that they'll do their best, but they can't make promises they can't keep. The second conversation is between a financial advisor and a client, a couple in their mid-50s somewhere in suburban America. The client is asking about inflation, about their retirement, about whether they should be worried. The advisor is recommending a standard balance portfolio, stocks, bonds, maybe a little gold. Silver isn't mentioned. These two conversations are happening in the same world at the same time, driven by the same supply-demand reality, but only one of those conversations acknowledges it. And the gap between what the boardroom knows and what the kitchen table knows, that gap is where the financial opportunity lives. Right now, today, that gap is enormous, and no one is talking about the real danger to silver supply coming from a direction most people haven't even considered: artificial intelligence infrastructure. Every major AI data center being built right now, and hundreds are under construction globally, requires silver in the connectors, in the circuit boards, in the high-performance computing hardware. Silver is not optional. It is not a design choice that can be engineered around. It is a physical requirement. The AI build-out is being described as one of the greatest infrastructure investments in human history. Trillions of dollars in hardware, data centers, and computing capacity being deployed over the next decade. Every dollar of that infrastructure has a silver component, and nobody, not the AI companies, not the government agencies tracking critical mineral supply chains, not the financial media covering the AI boom, is having an open, honest conversation about what that means for silver availability. But some people are paying attention. The smart money, the institutional investors who move quietly, who position before the headlines, who understand what happens when a finite commodity faces a structural demand shock from multiple simultaneous directions, those people are paying attention. The question is whether you're going to join them before the crowd figures it out. Let me be direct with you about something. I understand the psychological barrier here. Silver has frustrated a lot of investors. It has gone sideways for years at a time. It has attracted retail enthusiasm and then cooled. It has a reputation not entirely undeserved as the volatile, temperamental younger sibling of gold. And that reputation is going to keep a lot of people on the sidelines, not because they can't see the thesis, not because they don't understand the numbers, but because they've watched silver not perform before. And the human brain is wired to weight recent experience heavily. This is called recency bias, and it is one of the most expensive cognitive patterns in investing. The same recency bias kept people out of the stock market in 2009, right at the bottom of the financial crisis, right before the greatest bull market in modern history. The same recency bias kept people away from gold in 2018 and 2000. Same. The asset consolidates, it frustrates, it tests patience, the narrative fades, the crowd loses interest, and then in a compressed window of time driven by the structural forces that were building quietly underneath, it moves, and the people who were patient, who did the homework, who understood that the math was always there, even when the price wasn't reflecting it, those people are rewarded. The people who waited for confirmation, who waited until the headlines were screaming, until their neighbor was talking about it, until the financial advisor finally brought it up, those people bought the top. So let me tell you what being ready actually means. It doesn't mean putting every dollar you have into silver tomorrow. Concentration without diversification is not strategy, it is recklessness. It means understanding what your current portfolio's real exposure to inflation is. Most people dramatically overestimate how inflation protected their standard investment portfolio is. It means deciding what percentage of your wealth you want in assets that governments cannot print more of. Assets with finite supply, assets with genuine utility, assets that have preserved purchasing power across monetary regimes for thousands of years. It means distinguishing between paper and physical silver, and understanding the difference is not trivial if the scenario I've described in this video plays out. It means acting before the catalyst is visible to everyone. Because by the time it's visible to everyone, by the time the supply deficit is front page news, by the time the solar manufacturers are openly competing with investors for the same physical ounces, by the time the financial advisors finally put silver on their recommended lists, the move will already be significantly underway. The surprise won't be a surprise anymore, and the opportunity will have narrowed dramatically. I spent this entire video laying out the case, the monetary pressure, debt debasement, dollar confidence erosion, the structural mechanics, Pappertooth, physical ratios, what happens when they break, the industrial realities, solar, EVs, AI, defense, semiconductors consuming silver at rates the mining industry cannot match. Each of these independently is a compelling argument for silver together simultaneously in the same market at the same time. They represent a convergence I have not seen in my career. And I want to be clear about one more thing. I am not telling you this because I want you to panic. Panic destroys wealth, but does not build it. I am telling you this because the people who come out ahead of major financial shifts are not the ones who panic and the ones who ignore. They are the ones who look at the evidence, clearly understand the mechanics honestly, and position themselves with purpose and patience. That is what I'm asking you to do. Look at the evidence, understand the mechanics, be ready because the surprise is coming for silver investors. The only question, the only one that matters for your financial future is which kind of surprise you're going to experience. The surprise of watching it happen from the sidelines, or the surprise of realizing as it unfolds that you were positioned exactly right. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on. Subscribe to the Dimon Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. Because the investors who win are not the ones who react. They're the ones who are already ready. Silver investors are in for a huge surprise. I've just told you what it is.